Oh, hello everyone, and welcome to Magenta's annual investment update and recording. I'm Gretchen Betts, MD and financial planner at Magenta, and hosting with me today is Aled Burd, associate planner at Magenta. We're very happy this year to be again joined by Tertius Bonin, assistant portfolio manager at EQ Investors, and Laurentius founder of investment strategist from Timeline. So, hi guys, thanks for joining us again.
Thanks, Gretchen. Nice to be here.
Hi.
So yeah, they're going to spend some time with us today, basically answering questions about the market over the last 12 months, how bonds and equities are behaving, and what we need to know looking forward, hopefully, for the investment markets. As a reminder, those that have watched these before, but as a reminder, the information we provide and discuss in this recording is not to be taken as financial advice or investment advice from either Magenta, EQ, or Timeline. And as whilst we'll try to make this as relevant as possible to most of you, it isn't bespoke, it's not personalised advice for you. And if you'd like to discuss your situation and your investment portfolio specifically with us, please just get in touch with the team and we'd be happy to help. So let's dive in. I'm going to start my questions first. If you had to describe the last 12 months in the market in just one word, what would it be? And you can also add why you've chosen that one word. So I'll come to you, Laurentius, first, if that's all right.
Gretchen, I think it's impossible to describe the markets in one word. What I will say is I'll say resilient. And resilient, I think, is probably not the way you would think about it, because we've started out the year on very, very shaky grounds, and Q1, we've had this, well, let's start 2024, we had a really good year. We went into the year and people thought, well, okay, the markets are now overpriced. It's superheated. They're just waiting for this pullback. And then Donald Trump came to the scene with his Liberation Day that was just complete irrational. And we thought, well, finally, now we've got the markets pulling back. And then just from there on, it seems like the markets just sort of shrugged it off and continued with their resilience throughout the year. And especially now where we are, the last 2 quarters was just really, really good market growth that we've seen, despite all the high valuations, the geopolitical tensions, the tariffs around us. It seems like the markets is just sort of soldiering on.
So resilient. And Tertius, what about you? He might have stolen yours.
I was going to say, not quite, but a similar theme, right? But I think the word I'd probably pick is turbulent. I was trying to avoid the word uncertain, because I think probably any one of the last 5, maybe 6 years could have been described as uncertain and sort of, I don't know, everything seems to be unprecedented these days. But I think turbulent sort of works, because it doesn't suggest things that have been totally derailed in any direction, but we have seen volatility, as Laurentius just said earlier in the year with Liberation Day. So certainly volatility along the journey over the last year. So turbulence.
Thank you. So, and both of you have kind of alluded to, like, over the last 12 months, we've seen like strong rallies, but sharp pullbacks. Obviously, Liberation Day, did that for us. And we've seen kind of, when we look at those investment charts for clients, we see those big dips and kind of, but then quite fast pullback, sharp recovery. What do you think have been the key drivers of performance, and how have your portfolios adapted, if at all, to these shifts? So I'll come to you, Laurentius, first.
Yeah, I think the previous years, it was just all about AI and big tech at US companies, and it hasn't disappeared this year. I think it's still sort of the current theme going around, but I think what was driving returns this year, it's much more difficult to answer, because I think we've sort of turned back to good old fundamentals. Not just in the US. I think in the UK we've had a really good year based on valuations, based on company earnings. Not great, but better than mostly feared. We've seen that across Europe. We've seen that across emerging markets, across smaller companies against cheaper companies. Typical characteristics that has been lagging over the last 5 years have really sort of stood up and showed us some really, really decent returns. And then obviously alongside that, it was the AI-driven tech developments in the especially in the US, that have just sort of added on top of the already good performance that we've seen. So I think, in short, what was driving returns for me this year, it was good old fundamentals. It wasn't anything particular that can point out like last year.
I think maybe if I could just come in here as well, like we tend to think, I'm going to avoid sort of talking about AI for just a moment, maybe, but if we just were thinking maybe about the fundamentals out there, right? We have growth, we have policy, we have inflation. Now, we went through a bit of a growth scare maybe earlier in the year. We had the big tariff announcements, and I think the worst case scenario is pretty much receded for now, although I'll put a little asterisk next to that because the president's sort of comments on Friday may have reignited something. But actually, when we look to sort of fiscal policy, we have a lot of governments now, I don't know, very, very sort of spend heavy, especially in the developed world. So actually, this is actually quite supportive generally for sort of risk assets. And then we have sort of inflation, which I guess is the final point. And we came through obviously 2021, 2022, this big inflation event around the world. That has generally sort of fallen away for the most part. I mean, you have a bit of exception in the UK, maybe where inflation is a bit higher than it is elsewhere. But in the US and in Europe, inflation is much lower, and you're starting to see interest rates sort of come down. So that creates a bit of a sort of a positive backdrop for investors.
Thank you both. And actually, that discussion about inflation leads on quite nicely to my next question, Tertius. So I think, as you've touched upon, we're starting to see inflation and interest rates start to fall, and globally. And I suppose my question here is, maybe how are these factors influencing your investment positioning today, and what do you expect for the year ahead for both interest rates and inflation? So maybe could we start with you here, Tertius?
Yeah, I'm going to avoid the crystal ball sort of moment where I pull it out from under the desk and I give you a fantastic prediction. But there's always a new narrative, I think, emerging on the street as to sort of, I don't know, where we're going to, where we're coming from. We've clearly come from a period of higher inflation, higher interest rates. We're now seemingly emerging in a sort of a lower environment for inflation and a lower environment for interest rates. But I think one thing seems pretty unanimous at the moment is that the days of these ultra low interest rates is really behind us. So we obviously had this period from the global financial crisis to around COVID, where we saw interest rates practically at zero, and we have suddenly sort of come up and we've had interest rates in the 4 to 5% range, and the consensus is now that we're not going to go back to zero. We could very likely see interest rates stabilize in the sort of 2 to 3% range, and that actually has quite profound impacts for markets, for the economy, because it means that the cost of money is no longer zero. It changes the calculus with which people have to interact with the market.
Yeah, I think that's just you make a really interesting point about interest rates not going back to zero, and I've came across a really interesting analogy that compared interest rates to sort of they said it's the gravity of the financial markets. And when interest rates sort of were at zero, everything was just floated, and there were probably some companies taking on debt which shouldn't have taken on debt because it was all free. But now you can sort of see that gravity or interest rates is back, and it doesn't mean everything crashes to the ground. Probably if interest rates are back up at 12%, it will crash to the ground, but it's sort of at a level where you can still, valuations does matter, borrowing costs obviously does matter, but you can still rely on sort of accessing capital, not at a ridiculous cost, 3.5%. So I think it's sort of our new environment, and it's not necessarily bad. Yes, some companies would like to access cheaper capital. I mean, we as consumers would love to get a discount on our bonds interest rate, but at the end of the day, that interest rate isn't the thing that I think we should all be scared of. Even inflation has absolutely came down. I think the expectations is, again, there's no crystal ball, but I think the expectations is that inflation does have some more room to come down. But in the short term, I wouldn't be surprised if we have a small uptick in inflation. You have to remember that inflation doesn't come down in a straight line. we are entering into our festive period. People tend to spend a bit more. We know prices tend to rise a little bit over the festive season. So I think the consensus expectations for the UK is actually for inflation to go up to 4%. But at the same time, the Bank of England is well aware of that. And they said, well, they still expect another 25 basis points rate cut irrespective because it's normal. So I think if you combine those two, and there's actually a third thing that you have to combine with interest rates and inflation, because that sort of determines whether interest rate and inflation is good or bad, and that's economic growth. If you have inflation at 4%, it means that that will erode your public debt or the nominal value of your debt by 4% per year. That's not a bad thing if you can get some economic growth on top of that, because then you are shrinking your debt, but you are also increasing your pie. So I would say an ideal scenario would actually be to have a world where we've got 3-4% economic growth and inflation at about 3%, to just erode away a bit of that large debt pile that we've piled up over the last couple of years. But I think that economic growth piece is going to be crucial. And it seems like it has, as you said, it has become at least part of the story. I now just want to see a real sort of commitment to getting this economic growth globally in the UK, in the EU, and in the US going.
Yeah, thank you both for your insights there. So moving on, I think we're always going to ask for your views on AI and technology, and yes, the sort of growth is partly due to fundamentals this year, but there's always been that growth within technology and AI. And we've had a few reports relatively recently from the Bank of England and JP Morgan, and there's a little bit of talk now about possibly an AI bubble. So what we'd like to understand from you both in terms of this growth that we've seen in AI and technology, do you see this as a sustainable growth moving forward, or do you believe that parts of the market are now looking stretched? Maybe start with you here, Tertius.
Sure. I think it's difficult to say that some parts of the market don't look stretched, especially when on a almost sort of daily, if not weekly basis, you're seeing another announcement of another complex transaction coming through. I think there's just, I don't know, instinctively there's something a bit funny going on with OpenAI and the increasingly complex transactions that are being announced. For anyone sort of watching who's a Financial Times reader, there've been a couple of good write-ups, I think, on this, and you start to see this really complex web of I don't know, ownership stakes and transactions and sort of weird like vendor financing going on. And this is sort of a spectre of what was happening sort of 25 years ago in the tech bubble. I'm not going to go as far as to say we're in a bubble now. I think it's very difficult really to sort of say that. A lot of the companies out there who are leading this do have the earnings, the cash flows to back up their valuation. So it's difficult to say that some of the valuations in the market aren't warranted. But I think it's certainly there is a moment for reflection with some of what's going on, just to sort of sit and think, actually, does this make sense? But more widely, I mean, when you sort of take what AI can achieve, what good data analysis can achieve with the computing power that is being brought online, there are clearly huge benefits. I mean, there are loads of sectors out there that can benefit from, I don't know, actual proper good use of data and artificial intelligence. So that could very well be a route to growth, or just more sustainable growth, I should say.
Yeah, absolutely. I can echo everything you've said there, Tertius. And AI, it's one of those things when people say the word AI, I'm thinking, what do you mean by AI? Do you mean, because AI for me, it's nothing more than just a large language model, but do you mean tech? Because I think that's sort of what people refer to as AI companies these days, are your tech companies. And then I've actually written a blog the other day, and I have to warn all the listeners, if you ever come across one of my blogs, I don't write a blog because I know the answer. Sometimes I start writing a blog because I want to find the answer. So I've received a statement from a client saying, well, tech is now 35% of the S&P 500, but it doesn't include companies like Amazon, Google, Facebook, Tesla, because they are consumer cyclical or information, or not information technology, communication services. But they should be tech companies. They should be part of the tech. And if you include that, we've got more than 50% of the S&P 500 is tech companies, or let's call it AI companies, or what's the word you want to use. And I honestly was a bit baffled about that because didn't realize that. I never thought about it that way. And I started to look into it, and I then just realized everything is tech. Any company leading their sector these days are tech companies. Think about in the UK, I think that one of the most innovative companies in the UK is Revolut or Monzo, these challenger banks. They are financial institutions. Um, I don't know if any of you have been in a tractor, a John Deere tractor, last couple of years. It's basically a GPS system running on a GPS platform that looks like a tractor. So everything is tech, it should be tech. And I think tech or AI shouldn't be a sector these days. I think it is just part and parcel, and any company leading their sector is a tech company. So that's why I'm not too concerned about the concentration, and I think it should be an integral part of a leading business. But then also, what makes me really exciting about AI is I'm not convinced that we've got the political leaders in the world to get us out of all our crises, the debt crisis, the economic growth that we need. And I think AI really presents us with an opportunity to create something magical. What we need is productivity. And productivity, if you get 0.5% of productivity into your sort of ecosystem, that translates to 0.5% more economic growth. And 0.5% more economic growth means by 2030, the GDP to debt ratio will go from 130% down to roughly about 100%, which makes it much more manageable. If you don't get that, and you get, let's say, minus 50% or minus 0.5% economic growth, that debt will go from 130% to about 200%. So it just shows you how important it is for us to get economic growth. And I think AI presents us that opportunity to actually be able just to get that little bit, that extra incremental economic growth if we do it right. It obviously comes with its own threats as well, which I have to say scares me sometimes, but overall I'm more optimistic.
I think it's really interesting, that concept that, we're looking at that, 25, 30 years ago, the tech bubble then, but the concept then that actually everything that's managing to make money right now is tech related. So we even know in financial services that if we can make efficiencies by using technology, and some of that may have an element of AI in it, but if we can use technology to the best of our ability, even in a small company like Magenta, then we're going to make more efficiencies and we're going to be more profitable, which drives economic growth.
Yeah.
And if that's being adapted in every single aspect of business, including even public sector, NHS, and etc., healthcare, then that makes sense. So the concept that there could be a bubble in that is really difficult for me to comprehend, because it's the only way out of this kind of scenario that we're now in the modern world. So I find that really interesting. But I do think there are elements, absolutely, of large tech companies that have been driven significantly by AI over the last couple of years that could look overpriced, where we could see some corrections in the market. But really, they are forming potentially now quite a small percentage of what is actually tech-driven market. So it's quite interesting.
Exactly. And I think it's really important to just note that given all this optimism around AI, I can't guarantee anything, but I think the one thing that I can guarantee is at some point there will be a market pullback. There will be peaks and troughs in the market, and some of them will be more aggressive than other ones. We can't time it. I think it's one of those things, saying that AI is so attractive and these companies have such good fundamentals, they are not going to see a market correction in the next 10 years. It's not going to happen. There's going to be volatility with these companies. But I think over the long term, it can add that added benefit that you need.
So just coming off the back of that then, we talked a little bit about a couple of things. We talked about inflation remaining at slightly higher level, although at a manageable level, interest rates being slightly higher than zero, and that being the new world as such, of which we all need to adapt to. and I guess there's that thing of, is the global economy slowing down, or is it just normalizing? Are we becoming in this is our new normal? You know, when we look back at the last 20 years and where we've been versus maybe now, you know, as Tertius said at the start, like there's always something going on, right? There seems to have been, this is unprecedented, this is unprecedented. So, you know, how do you assess the strength really of like the global economy at present, and how might Timeline EQ be positioning portfolios in response to that, what feels like a kind of new normal, maybe a slightly slower environment, but with, you know, these interest rates being slightly higher, etc. Should we come to you, Tertius, first?
Sure. I mean, this is the golden question to a certain extent, right? I think something that we're finding increasingly hard to sort of grapple with is, I mean, sort of to your question, right? Where are we in the cycle? Because there's been, if you think about the sort of the classic business cycle of, I don't know, you go through recession and then you go through recovery and then you have an expansion, like that has been totally disrupted over the last sort of 5 years or so. We've had COVID, and we've had the huge intervention from central banks. I mean, this is a huge amount of sort of money that entered the sort of financial system, the wider economy, and then we go through the inflation period, and we suddenly have, I don't know, this huge expansion by governments in the amount they are borrowing and spending. I mean, if you look at the US, you look at France, you even look at the UK. I mean, there's vast amounts of money being borrowed and spent to just try and sort of prop up bits of the economy to eke out a little bit more growth here and there. So it's really disrupted this classic idea of we go through business cycles in a nice sort of wave through time, which is, I mean, it's very difficult to sort of, I don't know, place us. So I think when really this presents, like I guess, a number of risks really and opportunities on both sides. The opportunities being that if you sort of throw enough money at it, you probably will sort of kick back when a recession might start. So I don't think there are many economists out there at the moment, for instance, forecasting a recession in the next sort of 12, 18 months. That's a potential opportunity. That's good. That's good for risk assets. But on the flip side, the growing debt piles that a number of developed countries have is a risk. And we're going to see, I think, certainly in the UK, a bit of a pinch point potentially towards the end of November during the budget. We have I don't know, the current sort of situation that's going on in France, where the Prime Minister can't actually sort of pull together a majority in the Parliament there to pass a new budget. I mean, these are real risks, and they could very well spill over into bond markets. I mean, one of the things that we're doing in our portfolios is certainly favouring bonds that are sort of shorter maturity in nature. These are typically sort of I don't know, lower risk type bonds, and trying to at least minimize or really think about where we have exposure to those longer dated bonds where there is more risk to some of these events. Yeah, that's one of the ways that we're trying to manage this.
Yeah.
What about you, Laurentius? Yeah.
I think it's an interesting one. I think what you've alluded to, Dash, is about the shifting in the longer dated bonds that people. So 2022, especially the UK, I was really shocked when I came to the UK and I saw the average maturity debt that people in the UK invest in. I mean, inflation linkers had an average maturity of 23 years. It was really long, and then inflation showed up, and people were like, "Where's my inflation protection?" Well, you've got interest rate risk built into your portfolio that it's not going to give you the inflation protection immediately. In time, yes, you'll get it. And what I can see is the market have shifted, I think, to a more sensible position when it comes to exposure to duration or interest rate risk. It's just duration is just a fancy word for interest rate risk or interest rate sensitivity. So I've definitely seen a bit of a shift towards the short side. What I would say, if you still have your exposure, our view is that you should have exposure to sort of the whole market, the short end, the middle end, and some to the long end. But that should be controlled, and you should be aware that, and I think that's the key thing. Before 2022, we all thought fixed income or bonds is a risk-free asset because essentially there was zero interest rates. But we've very quickly came to discover that bonds are not risk-free. If you want to go risk-free, go to cash, but then you've got your own issues basically risking losing your purchasing power. So you need the exposure to these fixed income assets, but they are not risk free. They are less risky than your equities. So if you buy fixed income, I think it's just sort of know what you get and know where the risks are that you do expose yourself to. And I think it's very true. Government debt, especially in the US, I'm not too concerned about debt levels in the US because you have to think about the dynamics of reserve currencies and the fact that the US can just, I mean, about 70% of all global trade is being done in US dollars. About 95% of all financial transactions has the US dollar involved. So the US, they can print money. I'm not concerned that they are going to run out of it, won't be able to afford their debt. But then also, should they not be able to afford their debt, the prices of their debt will crash, and guess who's going to buy it back? The US is going to buy it back at a much attractive price. I'm afraid the EU and the UK doesn't have that advantage or that privileged position because counter to popular beliefs, the sterling and the euro is not a reserve currency. So we cannot print as much as we want. We need to find a way to get ourselves out of this debt spiral. And there's being more and more risk built into this government debt that we are looking at. But it is something that's being picked up by rating agencies as well. And I'm still fairly positive about government debt. I think we're going to get a decent coupon. I just don't think it's going to be risk-free the way people thought of fixed income pre-2022.
And so thinking about on the back of that then, where do you see the biggest opportunities really for investors in the next 12 months? Whether, is that a region, a sector, or is, a theme that you are following closely? Laurentius?
Gretchen, even if I had an active hat to put on, it would be very, very difficult to pinpoint to where do we see really anything or the next best thing. I personally do think there's a reason why the US is currently at about 63% of the global market or the global equity markets. It's not because I like what's going on in the US. I think things like tariffs, for example. I think the tariffs, for me personally, and that's a personal opinion, so please take it for what it is, but the tariffs, after calling Canada the 51st state, is the second stupidest thing I've ever seen in my life. I just don't see the economic or the rationale behind all these tariffs. But still, there's so much positive sentiment in the US. There's so much liquidity in the US. It is a market, a capital market that's much more attractive than the UK and the EU. And that's probably why valuations are much higher there. So there's probably a reason for valuations to be much higher. So I am positive about US and especially the way they are leading the AI race. I think the UK is not doing a bad job. The EU, I think, is has some personal reflection to do on how they can get back in the game when it comes to staying on the forefront. But for me, I just don't see an alternative to what's going on in the US at the moment, and that might not be a very popular viewpoint, but there's a reason why 62% or 63% of the markets are investing in the US at the moment.
What about you, Tertius?
Yeah,
Because you've got a slightly different angle with EQ, with sustainability. So I'm
Quite
just
right.
wondering if there's, anything else, and obviously a more active overlay on a
Yes.
lot of the stuff that you're involved in.
So I mean, clearly AI at the moment is the game in town that's sucking the oxygen out of I think a lot of other people's spheres. But once you dig under the surface, once you sort of think, what are the inputs into AI? There are some really interesting ideas that sort of support the wider AI growth story. And I think two areas that are quite crucial to sort of some of our portfolios are energy and water. These are both absolutely critical if AI is going to do anything. You need power if you want to have your data centers turned on, and you need water if you want to keep them cool. Otherwise, they're going to overheat and they're going to sort of not run. So, energy and water, two absolutely critical areas. Our portfolios have been exposed in both of these themes for quite some time now. Clean water, sort of renewable energy. This is energy efficiency. These sorts of ideas. But just to give you sort of a sense of the scale of change that we're seeing. I mean, already we were going through the sort of the wider energy transition that we talk about sort of quite widely. What that means, though, what that has meant is that for the last 20 years, if we just think about electricity markets in Europe and in the US, we've basically seen sort of a stagnant aggregate level of demand, and we've seen a bit of a change in the composition of mix from sort of dirtier fuels to more renewable fuels. What this AI trend is starting to do is actually inject actual growth into electricity markets for the first time in, I don't know, decades, literally decades. So you take Europe, I mean, Europe has literally been seeing declining electricity demand over the last 20, 25 years. The US has seen sort of pretty much stagnant, and we're talking about moving into sort of mid-single digits. And that move from 0 to mid-single digits is gigantic in sort of corporate earnings terms, right? So that's one area I think that we're seeing some really, really interesting sort of stories emerge. Another area, and it's a bit less sexy, I appreciate, than the AI theme, but healthcare sector is very much sort of at the heart of a number of our portfolios. It's a sector that has a very, very long track record in sort of execution. It's compounded very well over the last sort of 30 years or so. If you want to look at the best performing sectors over, I don't know, since sort of 1990 or so, healthcare is number 2 after technology. So it's a sector that, I don't know, has a very, very long track record of delivering some very strong returns, and it's sort of sitting very closely at the heart of the portfolios that we run.
Fab. I'm going to miss my next question because I think we've kind of covered it a bit. So Aled, do you want to just move on with yours?
Yeah, and I think, to be honest, it's quite nicely touching upon maybe what you've started thinking about there, Tertius, in terms of, I suppose it's just understanding what your both views are on maybe the ethical investment world, and maybe how that's changed over the past year. And we've touched upon him before in terms of Donald Trump and maybe his views on maybe the focus on ethical investing. And I suppose what would be good to understand is maybe how you believe the ethical landscape, the ESG landscape has changed over the past year, and really moving forward, what do you think the potential rewards are moving forward, if clients want to invest ethically? Tertius, I think naturally this maybe sits.
Yeah, happy to.
So if you're happy to provide a bit of
there's a couple of routes I guess you can go from here. I think one of the biggest areas that we get questions from clients, or have got questions from clients in the last year, is around sort of what the US means, what Trump means for sustainable investing. And our view here is that the whoever is sort of inhabiting the White House doesn't necessarily completely dictate what's going on in the rest of corporate America. I think one trend that we have definitely noticed, and we speak to a lot of asset managers based in the US, who, I don't know, they have noticed these most amazing trends, I guess, where in the last sort of 4 or 5 years, you've had a lot of corporate targets being set around, I don't know, whether it's sort of energy efficiency, whether it's sort of around carbon emissions, and suddenly a lot of these big sort of publicly disclosed targets have disappeared from companies' websites. And I think this at first alarmed us, obviously, thinking, wow, is this corporate America stepping back from a lot of these commitments? But actually, once we engage properly with a number of the asset managers out there, once they themselves had conversations with a lot of the big companies, what we found is that actually there's actually a trend of what's called green hushing starting to emerge, where companies are actually hiding the sustainability sort of targets that they put. They're still working towards those targets, but they're just not making it publicly sort of clear that actually they don't want to sort of open themselves up to, I don't know, a White House who's they're not sure what he's going to tweet the next morning. So yeah, we've seen a really interesting trend there, where I think there's a bit of a gap between what companies are doing and what they may be sort of publicly disclosing, which does mean that there's a bit of an information gap that could appear. But I think naturally working with asset managers who are sort of sustainability specialists, they understand a lot of these understand what's going on. They know how to ask companies for kinds of data that they need, and they can understand then the trends that are moving from here. I think another point, just very quickly to mention, is that the sort of toolbox of sustainable investment funds has been developing. This is for a little while now, and I think it's really sort of interesting. I'm going to borrow Laurentius's word from the beginning, right? But resilience is certainly a feature that we're starting to see amongst, I guess, the wider sort of set of tools that we have available to us in the sustainable investment space. And this is good because it means that we can then build resilient investment products. And if we look back, I think just maybe around the last 12 months as to what's been happening in markets, the volatility we've seen, the changing geopolitical landscape, like products are performing a lot sort of more in line with the wider market, which has not always been the case for sustainable investment. So that's a really good outcome in my view.
Yeah. I think if you put yourself in or through the lens of a investor looking at what's going on in the US, it seems like we've had a full pendulum swing from completely. You've got the one side that, to exaggerate now, stop eating meat and get rid of all the cows, and the other side just screaming drill baby drill, and then you've got all the people in the middle that, well, where's the common sense about sustainable investing these days? And when we say sustainable, I actually personally do think if you talk about ESG, to start with the G, governance, good governance. And good governance is a fiduciary duty of everybody in a company. And what is good governance? Well, let's set up a ethical governance structure in our company. Let's do the best possible for our shareholders. Let's look at things like, then you start to move to the social side of things. We all know diversity of thought, fair remuneration, all these types of common sense principles should be embedded in any business. So it's fair for investors to look at that. And then also you have to be honest about what's the risk on the environmental side. Don't we all want a more sustainable world? And I think the science is quite clear. I haven't heard anybody, well, you still get your outliers saying that climate change is a hoax. But I think the evidence is quite clear that we know the impact of carbon emissions in the industry. We know biodiversity is important. We all want to see a cleaner environment, cleaner oceans. And from my point of view, I do think there's been a massive, I don't want to say outflow, a massive tone down on the environmental or sustainable investment side, especially in the US. But I also think on the other side, we've had many investors that went into or rode the ESG train just to they thought they're going to get higher returns. And it feels for me like we've now sort of got into the space where you have your investors within your ESG investors that are really investing into these sustainable strategies because that's really what they want to do. They want to do it because they want that ethical edge. They want that moral layover or moral sort of umbrella over their investment portfolio, and that's a good thing. So there's definitely a lot of noise around it, but I think that most people are actually still using, just going back to common sense, what's good for us, what's good for the companies, and what's good for the environment.
Yeah, I think that's a really good point. I mean, in the US, I think ESG has become quite politicized when you strip it back, as you're saying, to actually what it means. I think a lot of people who may be naturally sort of, I don't know, may think that they're skeptics, actually see the common sense approach in it, right? It's that you wanting to invest in companies that don't have a track record of, I don't know, environmental pollution. You want to invest in companies that don't have a track record of bribery, right? These are in some ways like quite basic things, but these very much do sit under the ESG umbrella.
Yeah, absolutely. And, picking up a little bit on both of you, I think we've definitely seen a change in the discussion, and I would say we've got it. I feel more confident that we've got the right people in the right spaces now, when maybe before there was an element, as Laurentius said, about there was a big rally, everyone kind of jumping on that, and an attraction. And then obviously we've had a period, haven't we, Tertius, where we're actually, the ethical market has struggled a little bit, which has made clients compare where they are, and then also go, no, but I still, because of my beliefs, need to be in this space, and I want that, and I believe in that, and I need to do that. Versus some people who are either need to be doing something else, or feel that actually, no, they're okay with maybe a lighter touch ESG offering, or even an unconstrained traditional market view. And I think that I think with advisors that's been reflected probably in the last 18 months, and with most of the peers that I speak to, and the discussions we've certainly been having with Magenta clients. So I think that's quite interesting how that's kind of shown up. But I think it's important to be regularly having that conversation with people as well, because people's, views will change. And also something Tertius said is that actually the market and what you've available to offer and how those portfolios are changing become important to discuss as well.
Yeah,
So
I think, Gretchen, just to add then, the whole sustainable industry has, other than that, it has also sort of seen another dimension growing to it. It feels like when it started out, you knew what was good and what was bad, but then people were starting to get together and talk about what's good and what's bad and see developments in the world. So common things like nuclear energy these days. It's safe, it's clean, but you still have some past disasters that you want to avoid. So is nuclear now a good or a bad thing? And we're starting to have these conversations. Defense.
yeah.
Are countries allowed to defend themselves? Is defense companies in Ukraine ethical or not? And we get to start all these, and then even should some companies that's not good for the environment, take SpaceX for example, they are burning a lot of fuels, water waste. It's not a good company, but if you start to think about innovation, we are now talking about putting data centers up in space to get rid of all the heat because SpaceX were able to lower the cost of putting mass in space by 95%. So you sort of have to bring everything now together and say, where are we going to and what will be best for the world, where we're going to whilst not doing a lot of harm. So it's a lot of discussions that's going on, and I think it's a very, very dynamic environment that we find ourselves in.
Absolutely. Okay, well, we've got to round up. So, Aled, you've got a last question, and then we'll finish off as well.
Yeah, thanks, Gretchen. So I suppose my last question is maybe a little bit more light-hearted, but may take a little bit more thinking. So I suppose, and I'm going to ask you both to maybe get that crystal ball out and have a think of that. So I suppose thinking of the year ahead, so thinking about 2026. So if you must look forward and see the markets as a movie, so that's entering the screens ahead of us. What genre would you say that movie is likely to be? So could it be comedy, drama, action, thriller? And who would be the main character? So yeah, a little bit more of a creative question there. So I'll start with you there, Laurentius.
Jeez. I'm not the biggest movie fan. I'm terrible in games like 30 seconds. um, when I heard this question, I was like, it must be something like a thriller because most people see the markets as a thriller. They're just waiting if something is going to happen and what are they going to do if this happens. And I was like, no, that's not how I see the market. Stuff is gonna happen. I see it more of as like a good drama piece, where you've got this sort of unsung hero. You never know who this surprise hero is gonna be. There will always be drama every year. Um, if I have to think about a good movie that would actually reflect how the markets work, I think of something like Shawshank Redemption. It's just always soldiering on, but you do have your ups, your downs, your build-ups, and given given all the noise going on, I think the character, whether he's the villain or the hero, you decide for yourself. It's going to be Donald Trump. He's now in his first year, and the guy is a bit of an actor. We can't deny that. So he's going to be the main character in the movie. We've seen in the previous era or in his previous term that equity markets were actually performing really well under him. Then this year we've had mixed emotions, but nonetheless he's causing a lot of noise, and he's one of the main characters, whether you like it or not.
We are certainly, I think, living through another episode of the Trump show. I think I do agree that that the president of the United States is the main character. The biggest economy in the world, largest by a proportion of the global equity market by market capitalization. I mean, it's clearly sort of the Trump show at the moment. You're right, he's a showman. As far as a genre, I mean, these questions always stump me, but I think I had to eventually settle. The temptation to say horror, by the way, in the month of Halloween was pretty high, but I settled on Western because it does feel like there are a number of international sort of leaders out there acting a bit like cowboys, shooting from the hip, and it's difficult as well to maybe ignore these big tech companies out there, collectively known by the market as the Magnificent Seven, which is obviously one of the classic Western films out there. So yeah, I'm gonna go with a Western. Why not?
Yeah. That's such a accurate description. Think about Facebook that's just throwing $600 billion at a project which they don't even know whether it's going to be successful or not. So cowboys, I think that's a really good description.
Cowboys and bandits, yeah.
I love that. I love that. Absolutely. And it was a great question. I want to thank Aled for coming up with that, because that was definitely really good. Listen, thank you both for sharing your insights today and helping us out. Again, it means a lot, and I know that people watching are going to have got a lot from that. To everyone watching, I hope you found it useful, and it's given you a bit of a clearer picture of themes and markets as we head, into the end of 2025. As always, I'm going to say it again, please remember that everything we've discussed today is for general information only and shouldn't be taken as personal or investment advice. And if you'd like to talk about your circumstances or your portfolio in more detail, then please just get in touch with the team. And myself, Aled, or someone else from the team as well would be very happy to help. So thanks so much, everyone, for today. It's been a great discussion. Thank you.
Thank you very much.